Let's talk about some employer-sponsored retirement plans. We mentioned pension and profit sharing before. These are in addition to that, and they're kind of specific as to how they can be used. The first one is an HR10 or KEO plan. They're called one or the other, or sometimes they list it together, HR10 KEO. An HR10 KEO plan is only for self-employed individuals. That's a big, qualifier right there. Okay, so self-employed only. On a SEP plan, SEP stands for Simplified Employee Pension Plan, and what they are, it's very simple, far less expensive for an employer to set up because the employer sets up IRAs for their employees. Much cheaper than a big pension or profit-sharing plan. You don't have to do quite as much work and not nearly as much expense. So it's very good for these self-employed or small employers. There's another type of plan that a small employer can use, and this one is called a simple plan. It is another form of an employer-sponsored retirement plan. One of the big differences with a simple plan is it's 100 or fewer employees. So that's the restriction there for that requirement to use. The amount that can be contributed in all of these kinds of plans are adjusted every year by the IRS. And you don't really need to worry about those actual adjustments every year or what the limits are. They talk also here, we talk about a 401k. Any employer can offer them. The employer can choose to match what the employee puts in or not, or match a portion of it only. It's up to the employer. But this was the first type of plan where an employee could put their own money away, comes out of their paycheck pre-tax, so they get an immediate tax break because you've got your gross income that you've earned at work. They take your contribution and put it in your 401k, subtract that off your gross paycheck, and now they calculate your payroll taxes. So you get an immediate tax break by putting money in from your account. Usually it's done by payroll deduction, and it's always coming out pre-tax. So it means when you take any of that money out or any of the growth on that plan or the employer money that is yours, depending upon where you're at in the vesting schedule on the employer side, it's all going to be taxable at your ordinary income rates. Another type of a very specialized qualified plan is a 403B plan or a TSA, a tax sheltered annuity. It actually is an annuity, special type. There's only basically 3 major groups of people that are eligible to take advantage of a TSA. One is if you work for a not-for-profit organization, like say the Red Cross. Or if you have church affiliations, you're the pastor, you're the organist, something like that, you would be allowed to take advantage of a TSA. And then the other persons that are eligible are usually educators who work for like a state-funded college or university or a city school or a county-sponsored school or something like that. So those are the 3 major types. So pay attention when they're asking you questions on the test. If they give you an occupation that is not one of the 3 we just talked about, even though some of the other details kind of sound like it might be a TSA, it's not. It can only be, those not-for-profit organizations, church organizations, or teachers, professors who teach at some type of state, community, local, county-funded school, like a state college, for example. The only ones. So it is an annuity program. They are always set up by payroll deduction, comes directly out of your paycheck, okay, comes out pre-tax, so you get that immediate tax break again. And a test question you might see about a TSA talks about what type of an annuity has 0 cost basis. We haven't used the term much, but what cost basis means is money that you've already paid taxes on. Well, we just said on a TSA, the money comes out of your paycheck before taxes, so it's pre-tax. So that means all the money that you put in when you take it out, it's going to be taxable because you've never paid tax on it. Also, all the growth on that annuity, while it's growing, while you're still working and things like that, and until you take money out of it, the earnings or growth are all going to be taxable when you take the growth or earnings out, all of it at your ordinary income rates. So the answer to what type of an annuity has 0 cost basis, meaning no after-tax money, the correct answer is a TSA, a tax sheltered annuity. So that's a nice little recap of some of the options that an employer has for offering plans to their employees. Tax sheltered annuities, TSAs, or 403B plans, that's the actual IRS code, by the way. They are for not-for-profit, charitable, educational, religious, and other entities that qualify as a 501(c)(3) company. Again, that's IRS code is what that stands for. It's all employees of public education. That's a good way to think of it. Contributions by the employer can be made through payroll deduction. And the employee contributions are up to IRA set amounts. And again, you don't need to worry what the amounts are. You won't typically be tested on that, but know that the limits can change and that everything's coming out pre-tax. So when the benefits come to you later on, it's all going to be taxable at your ordinary income rates.